Hi guys, it's Doc's Market Minute for Tuesday, November 24th. Over the next few days, I don't expect a whole lot of market action, and so what I thought I'd do is I'd go into a little bit more about how I trade the High Probability Iron Condor. Now, what I'm going to show over the next few videos is kind of the offense that I use for getting into the trade, and then I'll turn around and show some of the defensive structures that I use as well too to risk manage and defend these trades, because again, as we all know, it's not what you make, it's what you get to keep on these trades that's so important. There's no point in winning 10 of these in a row if trade number 11 comes along and wipes out all of those prior gains, which is a very, very common thing for people that are fairly new to this trade. They get very, very confident with it. They get used to winning, they scale up in position size, and then all of a sudden, bam, they get whacked. And then your confidence goes back to zero again. And it's very, very difficult. So you have to have a real defensive structure when you trade these. In essence, what you're doing is you're becoming an insurance company. You're getting paid these premiums on a regular basis, and what you have to do is to make sure that you don't have one event that comes along and wipes you out. Okay, so let's get down to the offense. How do I enter these trades? Well, I'm a big believer that a strong defense is caused by a good offense to begin with. I mean, if you enter these trades correctly, if you do a good job of entering them, then you'll have very, very few defensive actions required as long as we have normal volatility. Now, for the high probability trades, these are the ones that were being placed way out of the money at specific delta levels for the short strikes. I'm a big believer in legging into these, but that's based on your understanding of price action. If you understand what's going on with a price action, then you can use that knowledge to work a wider wingspan on the Iron Condor. Now, I do not do this with the low probability trades. So the trades that are set up with a 1 standard deviation distance between the short strikes and a 1-to-1 reward to risk ratio on the trade. No, I don't do those. I enter them all at once. But I believe that if you understand what's going on with the price action, that you are leaving a significant edge on the table if you just enter it all at once. Now, I understand in the world of option trading that's akin to arguing about religion. There's a lot of people that don't believe in using the chart to gain an additional edge. They think that's hocus pocus. I frankly have been doing this long enough that I understand how to use the chart and do that. So again, that's up to you to decide whether or not you want to pursue a more random walk approach to your trading or whether you want to exercise a more technical approach to your trading. I'm not going to sit there and tell you that one is better than the other. I'll just show you how I do it here. Okay, this is October 26th of this year, October 26th, so this is a few weeks ago, and this is what I was looking at on the spiders. And particularly what I was interested in seeing is this formation here. This is a very common formation off of a bottoming pattern, is that we'll see strong off the bottom and then it goes somewhat sideways, and then we have what I call a parabolic tail, where the price goes almost vertically for a short period of time as people chase after the move. These are the Johnny-come-latelys, the late to the market Charlies that are jumping on board. And what we get from a technical signal from here is, in my world, is what I call exhaustion. So markets can only go for so far with a linear move before they exhaust themselves. And this signal in my world says that this chart's exhausted. So what I was able to do, and this is different. This is not where I enter the bull put spreads. I enter the bear call spreads into strength. So at this point, what I was setting up for December, and this is around that sweet spot, which is around 35 to 39 trading days until expiration. So at the end of October, on the 26th, I set up the 218, 220 spiders bear call spread. So from here, all I'm looking for the price to do, I'm not looking for anything magic to happen. So once I establish what I call my cornerstone trade, which is in one direction, okay, I'm looking for just a small retracement, and I'm looking to set up a trade below a technical level. So what I established was, since we already had a 10% correction, it's very, very, very unlikely for the price to come screaming all the way back down to here. It just doesn't happen. Tops are a process, bottoms are an event. So the tops being a process, I was expecting some type of retracement up here, up at this level in late October, to allow me to turn around and enter the bull put spread side. Now what I wanted to do was, originally wanted to get something down here, and then time was starting to work against me. At some point, you gotta fill in the other side of the trade. And so what happened was, a few days later, I was able to get a strike down at 190. This is not perfect. This is not precisely where I wanted it, but sometimes you just take what the market gives you. You can only trade the market that we have and not the one that we want. So here's the market that I had 5 days later. This is October 30th. And what we had a nice little red candle up here. And when you see a red candle, typically what you have is implied volatility will start to spike as people start to buy puts and hedge themselves against the move. They get scared. Oh no, I don't want to see my profits evaporate. And so this allows me to get a slightly deeper fill. And this is where I filled the 190. So 188, 190 bull put spread. So what we had at the end of this was a 188, 190, 218, 220. Iron Condor, and that's almost, if we look at the full S&Ps, that's almost 280 points wide, which is a pretty decently wide Iron Condor, given the fact that our implied volatility is relatively low at this point after this big rally up here. So we're not working with a whole lot of gas in the tank, a lot of premium in the option chain, and this is why I typically have to work these spreads a little bit. So let's think about this from a macro perspective. So we've got, I can't even draw this strike that's up here. It's way up here at 218, and we have, of course, the 190 down here. Okay, so that's our Iron Condor. Now, what are the odds that the price is going to keep on ripping higher and go straight up through 2135, which was all-time highs on the S&P? Pretty low. Without some type of reaction, and that's all I care about over the next few weeks, is that we have some type of reaction up here before it blasts higher through there. That's all we need. Time is on my side with us. So that's number one. Number two, what are the odds of the price dropping like a stone and coming all the way back down here? Lacking some type of really bad news or some kind of black swan, again, that's also a very highly unlikely event. So to me, this is where the Iron Condor begins, is that it has to make sense on the chart itself. I don't like to put trades that are sort of out there in space. So in other words, I don't like to be putting trades where my short strike is inside of resistance or inside of support. Sometimes you have to make some slight compromises, but my general sense is that I'm always trying to get these outside of resistance and support, if at all possible. Then to me, get it outside of the expected trading range going forward. Price can do whatever it wants to do, but if you trade with the probabilities on your side, most of the time, your initial defenses will be good enough for this. So again, this is how I leg into the trades. And to me, a great defense starts with a really good offense. And this is getting those strikes as wide apart as possible. So the rest of this week, what I'll talk about is actually defending the trade and some of the things that I can do to ensure that I have risk management on my side. In fact, again, I'm running an insurance company here. So how do I make sure that one event does not take me out? And how can I readjust these trades and kind of move them around in my favor? So we'll show that through the rest of this week. Thanks for listening, folks. We'll see you tomorrow.